Hey, what's up, my friend? Kris Krohn, welcome back. Listen, today we're going to be talking about Robert Kiyosaki, Rich Dad Poor Dad. He wrote a book about the 4 quadrants, and they're all about how you analyze business and how you analyze real estate. And so I thought for today I would be bringing in an expert member of my team, Acquisitions Director Tyler Bennett. And what he's going to do is together we're going to have a conversation about the 4 quadrants, and we want to show you how to actually do some basic math that will help you become a way more sophisticated, way smarter real estate investor.
'Cause we're gonna be legends. What we're doing here ain't just scary. It's about to be legendary.
All right, check it out. What we're gonna do right now is we're actually gonna break down this 4 quadrant method that's gonna help you understand when money comes into the business, when money comes into real estate, how should you be thinking about it? This is almost like doing a mini balance sheet exercise. And there's a lot of people that hate accounting because they hate the math, right? They hate the numbers. But in the end, one of the things that makes Tyler so good, so successful in everything he does personally, let alone business, let alone how he helps people in the world of real estate, is because he gets the math of this game. So we're gonna break it down for you to help you become far more intelligent today in understanding how simple this math is and that, of course, you can do it.
And we're really going to simplify this. And the intent with this is to really help you analyze a property really quickly. So you
Because
can just find
check it out.
numbers.
It can get freaking complicated at first glance if you're not trained on like, wow, there's a lot of numbers on here, blah, 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 blah.
Correct. So we're just going to dumb it down, really simplify it so that you can go find a deal. You can look up some easily accessible information and just analyze. And I call it the sniff test, right? You can do this, and at the end you'll know, oh, is this worth pursuing and spending more time on, or I just check it off the list and move on to the next one. Exactly.
Tyler passes the sniff test. It's good. Okay, good deal.
So we're going to start off, and we're really just going to break this down into 4 sections. It's like a profit and loss, where we're looking at income, we're looking at expenses, and what does it spit out? And that's what we're going to go through right now. I'm going to just draw this quadrant right here with these 4 sections, and we're going to start in the very top with income. Income, it's really simple. What's coming in on an investment property, and it's rental income. So we're just going to collect rents. Now, there's other types of properties out there. You may have storage unit, or you may charge for parking, or there's all kinds of other rent that comes in, but we're just going to focus on the actual rental income that a tenant pays on a house. We're going to start here, and we're going to have a couple assumptions. One, we're going to assume that we're buying a house for $150,000.
By the way, wherever you live in the world, wherever you live in this country, when we buy real estate, if you've read my book, you know that we're always going after entry-level single family, not because it's the best investment for everyone, it's because it's nearly the best investment for everyone. It 100% is if you're brand new to the game, if you're new to the game of finance and real estate, your first investment should be single family homes. That's a really good assumption on price point.
Yep. And super safe, right? So we're going to assume $150,000 purchase price, and we're going to assume $1,500 a month rent.
Perfect.
Okay? So again, you think of a profit and loss, you've got your income, and then below it, what do we have? We have expenses. Next, we're going to look at expenses, and this is where a lot of people err in real estate. They forget about all the different expenses.
Because they only take the big ones into account, like,
Yes.
oh, my mortgage is an expense. That's it. Everything else positive cash flow.
Yeah, exactly. We're gonna list them all out here. So we have taxes, right? We have insurance. What other expenses do we have, Chris?
You got the mortgage.
Yep.
You got the...
So we'll call that principal and interest.
Principal and interest. If you have property management,
Good.
there's going to be vacancies, meaning what percentage of the time will the house not be rented?
And is something gonna break eventually?
You're going to have repairs.
So we're gonna have property management. We're gonna have vacancy / repairs. Let's start itemizing these out. So for taxes, for example, we're gonna assume $150 per month. For insurance, we're going to assume $75 per month. The principal and interest, and we'll get to down payment in just a minute. Let's assume we put a 20% down payment, which would be a $30,000 down payment. So our mortgage amount's $120,000. I'm going to assume a 5.25% interest rate, which is it's a pretty standard rate for an investment property. Usually you're 3/4 to a point higher than you are on a primary residence.
Right.
So the actual mortgage amount would be $663 per month. Now, property management, this could be anywhere from 5% to 15%, depending on the market, the type of product. Big multifamily, you're going to be lower. And so it's important to know the type of house you're buying, what the property management should be in the market that you are for the product that you're looking at. We're gonna assume here an 8% property management fee, which puts us at $120 a month, and then vacancy and repairs. And again, this is where a lot of people err. They forget about this. And I kind of put capital expenditures in here as well. You've got your ongoing maintenance, and then you also have your roof replacement, your ACs that go out, flooring that needs to be replaced. And it's important to get these right. And one of the reasons we like these single family residences, we rent to families typically, and vacancies are very predictable in that type of market, where if you're doing student housing or different types of properties, vacancies may be much higher or much lower. For the sake of this example, we're going to use a 10% of rent number. So if you remember, our rents are $1,500, so that's $150.
You gotta get the bottom line right.
Yep.
So you gotta take all this and say, well, this is what the actual costs in my business are. Please don't refer to real estate investing as this anomaly that isn't business. It is 100% a business. And when you add all this up, this comes to what?
Let's be more conservative. Let's change this 10 to 12%.
Okay.
I feel like that's a better number to use for this example. Let's be a little bit more conservative because we always like to err on that side of things. So let's change that to 180 instead of $150 a month. So the total expenses are $1,188 a month.
Which means that if you're bringing in $1,500 a month, you have $1,188 going out. Basically, there's what? Is that $312?
Yeah, good math. Good math. So let's put that in this quadrant number 3 right here. Again, back to that profit and loss statement, right? You've got your income, you've got your expenses, and then what does that mean at the end of the day, which is our cash flow. So this one right here is called cash flow, okay? And that's simply taking the rent minus the expenses. So we have the $1,500 minus the $1,188, which equals $312 per month.
Awesome.
So now we've got to determine, what does that mean, right?
Yep.
If we did a $100,000 investment into this house, that's not a very good return.
It's a bad return.
Right? If we did a $5 investment, it'd be out of this world return. And so we have to determine, what does this actually mean? And I think a lot of people get distracted again here, where they look, oh, this is positive cash flow, this is a good investment. Well, God, it depends on how much you put into it.
And guys, where we're about to go right here, I want to make sure you understand. I hope you're following along, because this is pretty simple. I mean, taking the rents, taking the expenses, taking the cash flow, moving to this final quadrant, this is stuff you can do. You want to nod your head. You actually want to pencil out some examples right along. Teach it to somebody, because when you get in the real world of investing, these are just the basic principles that you need to understand to be a successful investor.
Yep, absolutely. So last is, again, what does this mean? And it's cash on cash ROI. What does ROI mean, Kris?
Return on investment.
Yep. So we want to know, what is that? We need to figure out, what is this number annualized to determine an annual return on investment. So we need to do 312 times 12 months. And then we also need to figure out, how much did we invest? What was our total property investment to get into this house, so that we can determine what that is. Let's look at that. So I'll call it TPI, total property investment. What do we have? We have a down payment, and what was it, Kris? 20% of that?
Be 30 grand.
30,000.
You probably have some closing costs.
We have closing costs. Unfortunately, mortgages are not free. Lending fees, appraisals, inspections, title insurance. There's a lot of third-party fees associated with buying real estate. So we have closing costs. I'm going to assume 4% for this particular example. So that's $6,000.
And then, did we have any other expenses coming into this? Did we have any other repairs? Did we have to add a fridge? Mm-hmm. You know, often when you buy a house, it might need something because it may not be entirely rent ready.
Yep. And I like that you said rent ready, because that's what I like to call it, rent ready repairs. And for this particular example, I'm going to assume that there was $3,000. So lipstick, right? Maybe we needed to touch up a little bit of paint. Maybe we needed to change a ceiling fan out. Maybe we need to add some blinds. But the property's in pretty good condition. We just need to do a few things to it.
Okay. If you add all that up, you're sitting at $39,000.
Yep. And let's do one more, and I'm going to call it miscellaneous. And I'm going to put $1,000 in there, because it typically costs money to place a tenant. If we hire a property management company, they may charge a $250 setup fee plus half a first month's rent in order to place them. So $250 plus $750, let's call that $1,000.
That's fair.
And that's total out of pocket to get into this.
So that brings us to a total of 40 grand.
Of $40,000 even. So now we need to take our investment. So the 312 times 12 is 3,744 per year, right? We just annualized that net monthly cash flow and got an annual number. And now we take the 3,744, we divide it by our total property investment. And in the end, we get 9.36% ROI.
Okay, so just pause for a second. What we're talking about is, how do I know how much money I'm making on what I put out versus what I'm gonna get in? This is not the total ROI of, because that would be a different balance sheet of, well, what are you gonna make this year and the second year and the third year? And let's say we're gonna sell in 5 years, and is the property appreciating? Is it growing? Are there any other liabilities? This is just first understanding, hey, if I take my money and I buy this asset, what am I gonna get back in return just as liquid cash? Not future gains, not appreciation. What am I actually gonna get? And Tyler, how would you feel if you were doing this deal and you were making 9.36% a year on your money?
I'd get super excited, but the way that I think you should answer this is that good for you, right? If you've been investing in the stock market for the last 5 years and you've been averaging 4%, that's a great return.
Absolutely.
If you own a business and if you put money into your business and you make 15%, it's not that good, right?
Yeah.
So it's relative for everybody, but a 9% cash on cash return on a single family residence real estate deal is phenomenal.
And if we start adding some other things on it, I'm in a market where we're growing at 4% a year.
Yeah.
I'm paying down a couple of percent each year value in my reducing my mortgage balance that is basically deferred cash flow that's going to be coming back to me. If I start adding in some of these points,
tax advantages, and really what you're talking about is an internal rate of return or an overall return, which is a whole nother discussion. Unfortunately, the math isn't as easy to do right on a whiteboard right here, but there's two ways to analyze the deal. First is this number right here, cash on cash ROI.
It's a good
That's
indicator.
what we get right here. And then also, okay, now what really can I make? And of course, it only goes up.
Yeah.
When you look at all the other benefits of owning real estate.
Boom.
Yeah, absolutely.
Yeah, so friends, today what we wanted to do is we wanted to cover the cash flow quadrant. For those of you that have read Robert Kiyosaki, cash flow quadrant, or are out there understanding, how do I look at my income in relation to my expenses? And if I look at my cash flow and my liabilities, what is my real overall ROI gonna be? And Tyler, dude, you did a great job, dude. You smashed it out of the park.
Yeah.
Broke down what this whole thing looks like. And it's time for you to go out and just pencil out 5 deals just like this to show that you get it. Because when I look at a deal and you're saying, what am I gonna make each year on my money cash in hand? You now know how to do that math. Guys, thank you so much for watching today. Tyler, dude, thanks for busting it out for us.
Thanks for having me.
And listen up, guys. If you're enjoying this, make sure that you subscribe, watch the next video. And you might be thinking, my next step is to actually get with some smart people that have lots of deals and can figure this out stuff with me, for me. And that's who we are. So if you want to know what that looks like, get with a member of my team. What they're going to do is we're going to do what we call a free game plan analysis. They'll put themselves in your shoes and say, wow, if we were you starting with all this money or no money or tons of debt or no debt or good credit or bad credit, we can help everyone get in the game of real estate. The question is, how are you going to get in the game of real estate? And we'll be able to deliver that game plan to you. So click that link if you want to know more what that looks like. Subscribe, and we will see you on tomorrow's video.